Okay, well, without further ado, let me introduce our first speaker, our keynote speaker. Ed DeMarco is an experienced executive in the Washington scene, having worked at a number of agencies, and currently is the acting head of the office, I always get this wrong, Federal Housing Finance Agency, a fairly new agency, which is he has complete authority over Fannie Mae and Freddie Mac. They're in conservatorship, is that the right word?
That's right.
Which means he gets to tell them what to do. So he has tremendous power and tremendous job in running these large organizations, at the same time adhering to what the Congress is pushing him to do and what the executive branch is pushing him to do. He has a PhD from Maryland, undergraduate degree from Notre Dame. We have a big Notre Dame fan sitting in the back row back there, Mike Cahill, whose son, your son, right? No? So without further ado, let me turn this over to Ed DeMarco to talk about the future of housing finance and the future of these agencies, I hope perhaps discuss that. So let me turn it over to you, Ed.
Thank you, Hans, and good morning, everyone. It really is an honor to be here at this conference today. I'm really pleased to have this opportunity to speak and have a discussion with all of you. And before I start, I really would like to thank Hans and also to thank Dewey Dane for their gentle persistence in wanting me to participate in this conference. It really is an honor to be part of this longstanding tradition and fine conference here at Vanderbilt. Before getting started, a couple of things. One, so the introductory remarks mentioned, looking forward to entertaining discussions. As a safety and soundness regulator, if I'm entertaining, I'm probably in big trouble. The second thing is, I may be able to tell Fannie and Freddie what to do, but that's not nearly as much fun as you might think. Third, a lot of this conference will be devoted to issues surrounding Dodd-Frank and the implementation of Dodd-Frank. I actually am not going to speak directly to Dodd-Frank issues, except to note for you all that, Dodd-Frank addressed quite a wide range of issues or presumed issues in financial markets and financial systems. It did not take up housing finance directly, but it certainly had a few things that affect housing finance, and it's been rather interesting, almost amazing to me how many things in that Dodd-Frank Act actually affect our agency and the role that we play. So we're, as an agency, quite involved in a range of interagency rulemakings across a wide array of subjects, and the director of the agency is one of the voting members of the Financial Stability Oversight Council that was created by Dodd-Frank. So, what have I been asked to address? I've been asked to address the topic of how we are maintaining the functioning of the housing finance system amidst the wreckage of the past several years, while we await legislative action that really is necessary to define the legal and institutional framework for the country's housing finance system in the future. Now, my agency, the Federal Housing Finance Agency, or FHFA, was created in July of 2008 to oversee Fannie Mae and Freddie Mac, as well as the 12 federal home loan banks. As you can see, FHFA came into being just as the financial crisis was taking full flower. Interestingly enough, most of the entities that we oversee, specifically Fannie Mae and the 12 home loan banks, were themselves created by Congress in response to the housing finance crisis that emerged in the Great Depression. Before going further, let me give a thumbnail sketch of the companies we oversee and their role in housing finance for any here that may not be familiar with them. Fannie Mae and Freddie Mac are chartered by the Congress of the United States, and they're responsible for providing stability and liquidity to the mortgage market. Now, their principal means of doing this is by packaging pools of mortgages. They do not originate mortgages, they buy them, but they package pools of mortgages into so-called mortgage-backed securities that trade in global capital markets. They provide the investors in these securities with a guarantee of timely payment, even if the homeowner misses a payment or defaults on their mortgage. All right, so basically what their function is to connect the capacity of global capital markets with local lenders that are making mortgages in hometowns all across the country. The federal home loan banks were created as a system of 12 regional cooperatives owned by their member depository institutions. The home loan banks make loans to their members. These loans are called advances, and they are typically collateralized with mortgages. In this way, membership in a home loan bank is a liquidity management tool for depository institutions, and it makes the mortgages that they hold on their balance sheet more liquid. This source of liquidity proved to be of critical importance to banks and thrifts during the liquidity crisis in 2007 and 2008. Home loan bank advance demand grew rapidly in that period and exceeded $1 trillion in the fall of 2008. It's been declining steadily ever since and is now more on the order of $450 billion. That's still a sizable portion of funding to many community banks. So while some home loan banks have experienced losses the past few years due to their investment in private label mortgage-backed securities, they have not taken any losses on their core business of making advances. Now, for the rest of my prepared remarks, I'm going to focus on Fannie Mae and Freddie Mac, but before leaving the home loan banks, let me just note that they continue to be a highly valued source of liquidity for their members, and principally for small and mid-sized institutions. And when Congress does get around to taking up housing finance reform, I expect that the home loan banks are going to be part of that discussion because they remain an important element of the country's housing finance infrastructure. Now, as I've already noted, my agency was created in the middle of 2008. In establishing FHFA, Congress combined two existing regulatory agencies and transferred some authorities that existed at the Department of Housing and Urban Development. And they gave this new regulator not only the component parts that I just mentioned, but also greater powers and responsibilities than existed at any of the predecessors. While many of these new authorities and responsibilities were designed to curb excessive risk-taking and to give the new regulator more authority to act, the legislation came far too late to stem the housing crisis or the collapse of Fannie and Freddie. Indeed, it was less than 6 weeks after being created that FHFA placed Fannie Mae and Freddie Mac into conservatorship. Since that time, FHFA has been both the regulator and the conservator of Fannie and Freddie, or the enterprises, as I will often refer to them. These operations have been made possible by the financial backing of the U.S. Treasury, backing that was authorized by Congress in 2008 and is implemented through Treasury's senior preferred stock purchase investment in Fannie and Freddie. To date, these senior preferred stock purchase agreements have resulted in more than $150 billion of taxpayer money being drawn from the Treasury Department to support Fannie and Freddie. Now, until a new system of mortgage finance is established in the United States, mortgage finance remains centered on Fannie Mae and Freddie Mac, and to a lesser but still very important degree, the Federal Housing Administration. I'd like to describe some of the steps FHFA is taking to meet its statutory mission as a conservator to preserve and conserve enterprise assets while ensuring that the enterprises continue to meet their statutory mandate of supporting a stable and liquid secondary mortgage market. The Housing and Economic Recovery Act of 2008, which created FHFA, specified two conservator powers, stating that FHFA may take such action as may be necessary to put the regulated entity in a sound and solvent condition and appropriate to carry out the business of the regulated entity and preserve and conserve the assets and property of the regulated entity. That's right out of the statute. Now, from the outset, FHFA stated that the goals of the conservatorships were to help restore confidence in the companies, enhance their capacity to fulfill their mission, and mitigate the systemic risk that contributed directly to instability in financial markets. Because the private mortgage securitization market had already vanished by the time we put them in conservatorship, and there were no other effective secondary market mechanisms in place, the enterprise's continued operations were necessary for continued liquidity in the secondary market and for mortgage originations to continue. Today, FHFA is balancing three responsibilities: preserve and conserve assets, ensure market stability and liquidity in housing finance, and prepare the enterprises for an uncertain future. While the long-term course of housing finance is being debated and ultimately determined, FHFA meets these responsibilities by overseeing the enterprise's management of and limiting the cost to taxpayers from the enterprise's $5.5 trillion position in the marketplace. FHFA has already taken some important steps to accomplish the goals of conservatorship. For example, it is important to us to keep the enterprises focused on their existing core businesses, not venturing into new lines of business and new products and things they were doing on the periphery they are no longer doing. This approach ensures ongoing liquidity in the mortgage market, it preserves the enterprise's core business processes, and it generates earnings, thereby benefiting taxpayers. Indeed, just yesterday, Freddie Mac reported its first quarter earnings, and it reported a profit net of the dividends that they paid to the Treasury, and that's the first time that's happened in nearly 2 years. We're looking beyond just a holding pattern, though. Where appropriate and feasible, we're working with the enterprises to make long-term improvements to the functioning of the housing finance system. Improvements that should bring dividends down the road, irrespective of the ultimate outcome of housing finance reform. We've announced 3 such initiatives. The first was announced last May, a year ago, when FHFA directed the enterprises to develop uniform standards for data reporting on mortgage loans and appraisals. This uniform mortgage data program is designed to improve the consistency, the quality, and the uniformity of data that are collected at the front end of the mortgage process. By identifying potential defects at the front end of the mortgage process, the enterprises will improve the quality of mortgage purchases, which should reduce repurchase risk for originators. This initiative is being phased in over the course of this year and next. Now, developing standard terms, definitions, and industry standard data reporting protocols will also decrease costs for originators and appraisers. It will allow new entrants to use industry standards rather than having to develop their own proprietary data systems to compete with other proprietary data systems already in the market. Now, the credit and pricing decisions Fannie Mae, Freddie Mac, or any future secondary market firm make based on these data will, of course, be where market participants will compete. Proprietary reviews of appraisal and loan information will depend upon each firm's unique business models and policies. But common data definitions, electronic data capture, and standardized data protocols will improve the efficiency, lower costs, and enhance risk monitoring, including for investors. The second initiative started at the beginning of this year when FHFA announced the Joint Servicing Compensation Initiative. We directed Fannie and Freddie, in coordination with us and HUD, to consider alternatives for future mortgage servicing compensation for single-family loans. The goals of this initiative are to improve service to borrowers, reduce financial risk to servicers, and provide flexibility for guarantors to better manage non-performing loans while promoting continued liquidity in the to-be-announced mortgage securities market. The third initiative we announced just last week. This one, our Servicer Alignment Initiative, is designed to produce a single consistent set of protocols for servicing enterprise mortgages from the moment they first become delinquent. This initiative responds to concerns that I'm sure you've all read about how delinquent mortgages have been getting serviced and it will simplify the procedures for mortgage servicers by giving them just one set of procedures to follow, whether the mortgage is owned by Fannie Mae or Freddie Mac. Turning specifically to FHFA's responsibility to conserve and preserve assets, it's useful to think about the enterprise's assets and property as having four categories: the legacy pre-conservatorship book of business, the post-conservatorship book of business, the business platforms, operations, and processes, and finally, the people. The first two categories define the tangible assets that exist today, and the latter two define the intangible assets that support and create opportunities for undertaking profitable business tomorrow. Given the structure of the Treasury's preferred stock investment in the enterprises, the entity with the greatest economic interest in the enterprises today is the taxpayer. Thus, we are preserving and conserving assets principally for taxpayers so that they may realize the greatest possible return from these assets, whatever the final form of the company's transformation ends up being. We do this with a clear expectation that at some time in the future, Fannie Mae and Freddie Mac, as we have known them, will no longer exist. But we do not know when or in what fashion this will happen. Each company, in whole or in pieces, may be transformed in some fashion so that taxpayers realize value from this investment in the way lawmakers determine is in the best interest of the country. What we do know is that the country's single-family mortgage market is roughly an $11 trillion market. The nation's housing finance structure depends on institutions capable of absorbing flows that a market of that magnitude generates. The coming debate will be about what those institutional arrangements look like, what degree of government support or subsidies involved, and what degree or role of government oversight is desired. Turning to the why question, why preserve and conserve these assets, there's this: to protect taxpayers from further losses, to ensure market stability and liquidity, to give lawmakers options for the future, and to protect the future value of the enterprise's intangible assets for future utilization and value recognition for the benefit of both taxpayers and markets. Even though we don't know the future of the companies, it makes no sense to be diminishing or denigrating these assets. So as conservator, we oversee them so that value may be returned to taxpayers. Let me turn to the risk management issues all this entails. First, for the legacy book of business, the mortgages acquired pre-conservatorship, the key risk is further credit losses from delinquent mortgages. We've been working very hard on effective loss mitigation strategies to avoid foreclosure where practical and to minimize further credit losses through loan modifications and other loss mitigation strategies. At this point, since conservatorship, the enterprises have taken some foreclosure alternative activity on 1.5 million mortgages. The majority of that has been in the form of loan modifications. Second, for the post-conservatorship book of business, the key risk management challenge is establishing appropriate underwriting standards and risk-based pricing. Since conservatorship, underwriting standards have been strengthened considerably at the enterprises, and the guarantee fee prices have been increasing. Third, the enterprise's business platforms, operations, and so forth present multiple risk management challenges. We and others have reported previously on the operational and risk management shortcomings that contributed to the companies ending up in conservatorship in the first place, and both companies have been working since to remediate those deficiencies. But for a company in conservatorship and unlikely to exist in its current form, thinking about whether and how to invest and develop infrastructure and operations presents unique and difficult challenges. Finally, how does one preserve and conserve the value of a company's human capital in the face of such an uncertain future? Recruiting and retaining executives and staff is one of our principal risk management challenges as conservator. Leadership challenges at the company, changes at the company will continue to take place. Already in 2011, we've seen several key executive-level departures at each company. The enterprises need to be able to continue to attract and retain executive-level talent and professional staff to be able to navigate through this period of uncertainty. For the duration of the conservatorship, I believe the best way to protect taxpayer interests in the enterprises is by ensuring that both companies have the experienced, qualified people managing the day-to-day business operations. Any other approach would put at risk the $5 trillion in mortgage holdings and guarantees that are supported by the taxpayers through the Treasury investments. So, I've just described for you how FHFA and the entities we oversee are helping to maintain the functioning of the nation's housing finance system today. But the big question, the key source of uncertainty, is what will that housing finance system look like in the future? In 2008, when we put the companies in conservatorship, Treasury Secretary Paulson described the conservatorship as a timeout so the incoming administration and Congress could decide the ultimate resolution of the enterprises and the legal and institutional framework to replace them. This is turning out to be quite a timeout. It's been over 2.5 years now. I've said many times that conservatorship cannot go on indefinitely, though it seems to be happening. And that certain risks that are associated with conservatorship actually increase over time. I'd also note for you that the only resolution of the conservatorships available under current law for FHFA is to reconstitute Fannie Mae and Freddie Mac as they were with the charters that they had. Even if that were feasible, that seems to be the only option that people in Washington can agree they don't want. So, where are we in all of this? In February, the administration issued a white paper on housing finance. It did not have a specific proposal, and it did not state an administration preference. It did provide 3 broad options for the future, and these options varied basically on the degree of government involvement. First option was a more purely private option that would have the function that the enterprises currently play in the marketplace be taken over by purely functioning private entities without any government involvement. The second option, what they sometimes refer to as their National Guard option, would be to have a privately functioning mortgage securitization market, but standing back in the shadows, a government mechanism to come in and provide guarantee or support to that process in times of market disruption or uncertainty. And the third general approach that they put forward was what they described essentially as a private securitization market, but where the mortgage-backed securities that trade would be essentially wrapped by the federal government with an ultimate federal guarantee of payment to the investors. So the presumption here is that you'd have entities, something like Fannie and Freddie, that were issuing mortgage-backed securities, and perhaps there's a corporate guarantee on it, but ultimately there would be a federal guarantee backing those securities, so investors would have the ultimate credit protection of the American taxpayer. Now, these were stated in broad form with no real framework put to them. They also, in this white paper, had several things that they directed, or didn't direct, careful there. They suggested that FHFA could be doing to be moving things forward. And in fact, many of these things they suggest are things we were already doing, such as shrinking the portfolios, tightening underwriting standards, increasing guarantee fee pricing, and so forth. Now, we've seen emerge from various industry groups and researchers frameworks that pursue one or the other of these options to spell it out a bit more. So, for example, some researchers at the American Enterprise Institute have put out a paper that essentially looks at that first option and provides, their take on how that first option might be implemented, the purely private option. And in their particular framework, there's heavy reliance on mortgage insurance companies as being where mortgage credit risk is essentially both priced and managed. And it puts the definition of a prime mortgage, something that essentially, for many years, Fannie and Freddie were seen as being the ones that defined what prime mortgage was, and In essence, that was what their statute told them to do. It would put this definition actually in law. But there's some things to be worked out in that proposal, such as issues of how standard setting would be done in this marketplace. I haven't seen anything that really touches on the second option, but the third option about a government guarantee wrap, there are several proposals that out there that take this. The Mortgage Bankers Association has one, Housing Policy Council, and the Center for American Progress each have variants on this that they've put forward. Now, the calls for guarantees or for having some kind of ultimate government guarantee around mortgage securities in the future seems to, in some ways, implicitly assume nothing changes in our mortgage markets regarding underwriting or the information that's available to investors or what we ought to expect of investors or fundamentally who those investors in mortgage-backed securities would be. But I do think, in fact, this is an important place for researchers, policymakers, and the industry to really be thinking hard. So as we approach this housing finance reform, it's often described, as it is in the Treasury White Paper, as what is the role of government? Start with what is the role of government. The other side of that coin, of course, is what's the role of the investor? What are we expecting out of the investor? And what's the investor need in order to be able to carry out that function? So there's credit risk in mortgage lending like anything else. So where are we going to assign that credit risk? And how are we going to assure that there's prudential underwriting and careful and appropriate pricing of that risk, unlike what we've seen over the last decade? What's this new framework going to be like so that anyone who's owning that risk knows they own it, and we're not operating with things going on in the shadow that results in credit risk being mispriced? In the framework, wherever one comes out about this, should consider several things. It should consider what are the essential base elements of underwriting, or in other words, what are we expecting to be the key characteristics of a mortgage that is going to be trading in secondary markets. Supporting that is getting consistency in documentation. So the data quality initiative that I spoke of earlier is a start in that direction. Another piece is transparency for investors, particularly if one is expecting investors to actually take on credit risk, for private capital to take on mortgage credit risk. There's got to be transparency both at the time of purchase and through the life of the security about the mortgages that the investor has risk against, so that they can see into that, be able to price it and evaluate it. We also need to rethink the servicer model, and I described several things that we're doing today in that direction. But questions about compensation to mortgage servicing, accounting issues, capital requirements for mortgage servicing are all key elements of things that need to be fixed out. So fundamentally, we've got to get to clarity about what is the role of the taxpayer and where is risk truly being assigned, priced, and managed. And once we have those things, do we have a legal and institutional framework that is going to allow that to work effectively? And finally, I hope that as we do this, we don't get too fixated on mortgage products today. There's an awful lot of discussion today about preserving the 30-year fixed-rate mortgage and so forth, and I'm not arguing against that, although 30-year fixed-rate mortgage is really not for everyone. But in fact, to have a marketplace that can continue to innovate and to provide a diversity of product offerings. This is a big country, lots of different people with lots of different situations. And so the mortgage market of the future really needs to be not just liquid and stable, but it needs to have an appropriate diversity of offerings to the people that want mortgages in order to purchase houses. So with that, it's a pleasure to be here, and I've got plenty of time left, and I look forward to taking some questions and having some discussion with all of you. But thank you so much.
You talked about transparency of the enterprises. How much transparency are you going to give out in terms of, for example, delinquencies of the loans and so on? And you talk about standardization. Is it very easily available?
Well, that's a good question, Tom, because in the GSE model, where investors were looking to the capital of the enterprises as the credit support on the mortgages, and then it was, widely discussed, no matter how many times disclaimed by the government, widely discussed that ultimately those securities were implicitly guaranteed by the taxpayer, and as we found out, that wasn't such a bad assumption. The availability of data on the actual mortgages in the pool, what investors had, there wasn't there. And in some sense, the demand for it that might have otherwise grown in the private sector was deflected because of the perception of the credit support. Since conservatorship, we have taken some steps to improve the disclosures of mortgage data on what's going on in the pools. And early last year, both companies really stepped that up because when they changed their accounting practice with regard to pulling delinquent loans out of mortgages, that provided investors a greater insight. But to me, this is a longer-term question, and we're taking steps in that direction with Fannie and Freddie. But in the future, Fannie, Freddie, whatever replaces them, whatever else is out there, I think that investors should have, and we should have an efficient mechanism for ensuring that there is good granular data to investors about the characteristics of the individual mortgages that are in pools. If we expect private capital to be able to price risk efficiently, both credit risk and prepayment risk, they've got to have appropriate information about what are the characteristics of the loans in a pool. And so I think that this is one of the areas of that needs a lot of further development, but it is something we're actively working on. Yes, sir.
Do you see government getting out of the guarantee business at any time? And if so, how long do you think it might take?
The answer is no. I do not see them getting out entirely. The way I think about it is this. So from 0 to 11 trillion in single-family mortgages, some portion of that's still going to be government. I mean, I don't think that the FHA, the VA programs are going to go away. They could be changed, they could be expanded, they could be shrunk. But there's going to be some portion of the market that I think is going to remain traditionally government guaranteed, as we have had it for many decades. The question then becomes, within the sector that Fannie Mae and Freddie Mac have traditionally played in, is some portion of that going to move over to the FHA world, or is some portion of that going, or all of it, going to be replaced by something that does have a government guarantee, something like option 3 in the Treasury paper? Is it going to be all of what Fannie and Freddie used to do, part of it? That's really the big question. But it's somewhere in there is, I think, really what we're talking about, the continued role of the government. In any event, I hope that as we proceed, whatever lawmakers decides in the best interest of the country to have government support, I hope that there is real clarity about where those boundaries of government support are, and that there are appropriate and rigorous mechanisms for transparency of the taxpayers about the risk that they have, and that risk is being appropriately priced and charged to the market. In my career, I've worked on a number of different government guarantee and insurance programs, and over time, a lot of them don't have a great track record of being able to continually price risk on an appropriate basis. They may start out that way, but over time that tends to deteriorate. So that's where this debate's going to play out.
The three options from the white paper all seem to be, well, the first one is privatization, no guarantees, no
Right.
government involvement.
Right.
The second one you said had some element of guarantee. The third one was more guaranteed.
Right.
But none of them involved buying mortgages and raising funds and holding portfolios of mortgages. Is that correct?
That's correct. They're all secondary market proposals. So on the presumption that the mortgage origination market and the primary market would stay largely as it is, but this defines basically the pooling and securitization of mortgages. It is not, the discussion really doesn't focus now on large retained portfolios of mortgages like Fannie and Freddie used to have. This is about defining the degree of government involvement with or government backing of mortgage-backed securities in the future, outside of the FHA Ginnie Mae space.
The mortgages themselves are privately
Privately originated, privately financed, privately insured. So, I mean, there presumably could still be mortgage insurance that was on low down payment mortgages like there is today. So the government involvement would be on a pool basis. It would be wrapping the whole thing, not on an individual loan basis. Mark.
Can I ask you a question about executive compensation?
Everyone else in Washington seems to, so.
I mean, there's an argument that top executives get paid a lot of money because they're worth it. They create value. There's also an argument that the shareholders have no seat at the table, and that's why. But you're hiring people to preserve the assets in a relatively complicated company. So without giving away people's salaries, can you say how you think about this executive compensation issue? And what do Wall Street salaries mean about the salaries that you've got to pay in this conservatorship?
Yeah, thanks, Mark. This has been an incredibly challenging issue. Executive compensation. So as an economist, I think about needing to hire and retain staff, including high-level executive staff, to do certain things. So as an economist, I think about, among other things, what's their opportunity cost? What is it that's going to attract them? The return to them is their compensation plus whatever satisfaction they get, and some of them really do count on this, the satisfaction they get from being part of helping the country through a very difficult period. And we've had a number of very senior people come from corporate America into Fannie and Freddie post-conservatorship, knowing about all this uncertainty, in part because they were motivated to want to come and be part of, fixing this mess we've got. And yet, the timeout that I talked about earlier, no one really, now we're seeing that timeout is going to be measured in quite a number of years. And so this then says, well, how do we attract and retain them, over a prolonged period of uncertainty? And the opportunity cost of being at Fannie and Freddie, grows, particularly as the rest of the financial system recovers, as financial firms, big banks, and so forth are now hiring rather than reducing staff. That opportunity cost becomes greater, and so that's very much part of what we are weighing here. What we did when we took over, when we put Fannie and Freddie in conservatorship, all the bonuses, all of that was stopped immediately. We put some folks on retention plans. We worked a lot with the FDIC following their model in the bank failure realm. Then what we did is we worked directly with the Treasury Department, which for TARP institutions, by law, for the significant TARP recipient institutions, had to develop an executive compensation framework for TARP. So we worked directly with Ken Feinberg, the special paymaster, to develop an executive compensation program at Fannie and Freddie that was modeled after TARP, appropriate to the circumstances of Fannie and Freddie. So where we've ended up, I think, is really somewhere in the middle. On the one hand, doing my economist thing, on the one hand, executive comp at Fannie and Freddie has declined, on average, you look at the top officers, has declined 40% since pre-conservatorship. So I don't care who you are, what you're making, 40% reduction in compensation is a pretty sizable reduction. It's a reduction so that, for the executive folks at the enterprises, their compensation today in 2011 is what it was in 1999. So that's a fairly substantial reduction. On the other hand, as my Inspector General has pointed out to me, and as some members of Congress point out to me, they're still making a whole lot more money than the people that run FHA or Ginnie Mae or FHFA for that matter, and to be aware of that. So this is the balance that we've struck here, and I think it's appropriate. There's a good bit of deferred compensation that serves certain retention purposes, but this is a long range, but that's the basic balance. There has been substantial reduction in salaries, but there still are, salaries that we think we need to have to be competitive with someone that's going to be a chief risk officer, a chief financial officer, a chief business officer, at a company that is managing over $2 trillion worth of mortgages.
And you hire Maybe a few
We
floating
do.
around here that want to-
We do. In fact, we hire them at FHFA, and I can tell you FHFA is hiring, and so we would welcome that. In fact, our colleague Sandy Comenance is here, and she has some information for any of the students that are here that might be interested. If I could use that for a moment just to go off on a different topic entirely. It has been a real honor for me to be a civil servant my whole career. And, you know, many of you academics here, I've talked to a number of you, and you've spent time in Washington, and you are churning out very fine students. And I'd ask you to encourage them to think about a time in Washington, to think about public service. We may not pay even what Fannie and Freddie are paying in conservatorship, but we do very important work. And, you know, for all the different hits we get, and we don't get everything right, the country still needs people that are, you know, really dedicated to public service and willing to come in and spend at least a portion of their career working for the good of the country. The country gives us so many good things, but it really needs, you know, strong, sound folks working in government agencies doing their best to do the right thing for the country. So I hope we've got some students back there. Take that into consideration. Would love to talk with you.
And Sandy's talking to some placement folks. So we're ready to do what we can to supply the talent to you, and appreciate your joining us. One last question. Was it not?
There's one right here.
I just wonder about ending the timeout. As a parent of two young kids, managing a 2.5-year timeout seems like an awfully tough task. What is your best sense of how this ultimately gets resolved? Do you have a sense of what the timeline is likely to be, what the current plans are, and where it will likely end up? And also, what are going to be the, if you will, the trickiest political elements as well as the technical elements? This certainly used to be quite a politicized world.
Right.
I don't know if the crisis has changed that, or if the fault lines have moved, or if they're still just as bright as they always were.
Yeah. Well, housing is always going to be a very politicized topic. Every district, congressional district in the country has realtors, has home builders, has mortgage bankers, has bankers, and they have homeowners. So it is of interest to everyone. Currently, as I talked about what the administration put forward, but I didn't talk about what Congress is doing. In the House Financial Services Committee, they've been starting to have a series of hearings on housing finance reform, and the new Republican leadership in that committee has introduced a series of bills. Rather than doing a bill on housing finance reform, they've introduced at this point 8 bills, on average about 3 pages long, dealing with one particular topic. And so they're moving those things through, but these are all taking individual issues. A lot of them are actually directed at us in terms of further developing the conservatorship to prepare the way for, you know, an ultimate resolution. But there is no plan yet that anybody has for that. As for the timing, you know, my crystal ball is probably cloudier now than it has been in terms of that. I really don't know. And, you know, just the chatter in Washington is that even though to the rest of us it's the 1st of May in 2011, and, you know, presidential election is, you know, nearly 2 full years away, and that seems like a long time to us. In Washington, not quite so long away. And so I sure hope that Congress makes meaningful progress on this topic this year. But honestly, I don't know when they're going to get a full plan together and have what it takes to get this done. You know, they got a 2,000+ page Dodd-Frank bill done in reasonably short order and covered, you know, a tremendous amount of ground with it. It can be done, but whether it will be done or not, I just don't know.
Last question.
How do you see Fannie and Freddie's role in the multifamily asset market changing going forward?
Well, a key change that's taken place, thank you. You know what, people seldom ask about multifamily, and yet, you know, we've got a good portion of our populace living in multifamily housing, and when you think about issues of affordable housing and the less well-off in our country, multifamily housing is really a very critical topic, and where a lot of focus ought to be. The key change in multifamily since conservatorship, Fannie and Freddie remain really the key source of credit in multifamily market, at least the portion of the market that they traditionally served. But the key change is that they're not doing multifamily lending on their own balance sheet. Virtually all the multifamily lending that Fannie and Freddie have been doing has been through securitization. And I think that that's an important step forward because, again, whatever happens to Fannie and Freddie, I think looking to a securitization market for multifamily lending needs to be part of what we are considering. And so I'm pleased that we've been able to make some steps forward in the securitization of multifamily loans. Well, very good. Thank you all. It's been a real honor to be here.